G'day, Ryan. How are you, mates?
Yeah, good, Greg. How you going?
Very well. Today we are talking generating income from stablecoins. We put out a quite a lengthy report, or I should say that you wrote it and put out quite a lengthy report last week with a number of strategies. We didn't get any specific questions on executing those strategies, so we can safely assume the report was so well written that no one had any questions.
Yeah.
Or it was so confusing that people didn't even know where to start. So just to reiterate, if you do have any questions about putting any of these strategies into place, please let us know, send us an email. But for now, we just wanted to, I guess, go through a couple of the main points of that report. I had a couple of questions myself. So I might start off. And just to sort of, or actually before I ask my questions, maybe we should just reiterate what that report was about, and I'll let you do that.
So that was our main monthly report, and the idea was we wanted to start this journey into decentralized finance in the I'm going to say least risky way. Of course, everything to do with this new technology behind blockchain and cryptocurrencies comes with different risks and added risks. But as a stepping stone into the world of decentralized finance, stablecoins are the least risky aspect. So what we want to do with the first monthly report on that aspect of crypto, the main monthly report was to show you how this world of decentralized borrowing and lending works, and how you can use stable coins to generate interest from that. And so in reality, it's actually a pretty simple concept, is that you get these things called stable coins, which are cryptocurrencies that try and maintain a one-to-one peg with the US dollar. So they use different mechanisms, but they try and make sure that one tether or one USDC or one DAI equals very close to one US dollar. And so once you've created these stable coins, they can exist in the on the blockchain. So they can exist in the DeFi ecosystem and can be used like dollars. So that's the use case of them. And a big use case for them is, like there is with any source of money, is borrowing and lending. So what the report explained was how this decentralized world of borrowing and lending, these stable coins. So some people savers want to deposit their money and earn an interest rate. And then on the other hand, you've got borrowers who want to borrow money for whatever reason. Maybe they want to use it to trade, or maybe they want to use it for something else, whatever they want to. What the report explained was how these two entities can exist in the DeFi world without a bank. And without a bank, they can come together, and the rate of interest that borrowers pay and the rate of interest that savers get is just determined by market forces. And that can only exist due to blockchain technology, which uses a system of decentralized smart contracts, or computer code built on the blockchain, to do away with the need for a bank. So it's a really interesting use case for cryptocurrencies and for blockchain technology. And the sort of difference between this and the traditional banking system is there's no central bank, there's no interest rate setter as such that sets a reserve bank rate. And so that means that savers, people who have got money to save, can earn a market return. And look, when I first started experimenting with this a few months ago, I was getting like 11%, 12%, and even higher at times yield. What happened since then was there was a bit of a price crash in the cryptocurrency market. And when that happens, the demand for borrowing stable coins falls away, because people who were borrowing this to trade into other cryptos to make money are suddenly, on the reverse, they're paying that back. So the demand for borrowing falls down. And so that means the interest rate falls down a bit. So by the time we got the report out, the yield had fallen to, closer to 4%. And I think now it's about 3.5%, 4%. But that interest rate that people who have got stable coins, so savers, what they'll get will, might be 3.5%, 4% now, but that could easily rise to 10% if we get another, bit of confidence back in the market, and sometimes even higher, 20%, 30%. It fluctuates, but it's purely market dynamics which set that interest rate. And
I guess I was going to say that's the tricky thing, isn't it? Because we're so used to tuning into the RBA or the Federal Reserve once every month or couple of months and say, okay, what are they doing with interest rates? And then the banks move as well. But in this market, the interest rate can move pretty quick.
Yeah, exactly. And think of the difference. You've got, a centrally planned economy where economists and central bankers are trying to take into all the aspects of the economy and come up with an interest rate to suit the whole economy. And let's be honest, I know our opinion is they've probably stuffed that up pretty badly by giving us, like you called in one of your reports, life at zero, a world of continually zero interest rates and even negative interest rates in certain parts of the world. So that's the centrally planned economy, the current world of banking. In the decentralized finance world, the rates for borrowing, lending, even specific stable coins can vary. So you might get one rate for borrowing USDC, which is a more regulated stable coin, which it's backed by money held in bank accounts in the US and audited every month or attested every month. Or you get another stable coin like DAI, which lives purely in the crypto ecosystem, and it uses the collateral of other cryptocurrencies like Bitcoin and Ethereum to back the dollar value, and that might have a different interest rate. So it's to me, people say that's risky, but it's actually a free market world where the rates that savers get and the rates that borrowers get is based on the risks and opportunity that they're taking, which is, I think, although this is all very early days, over the long run, that will create equilibrium interest rates that actually suit the markets that these products are going into. And I know that sometimes these stable coins can seem like esoteric things because they're so new, but Visa, for example, are talking about using stable coins, USDC in particular, to start settling credit card payments and transactions around the world. So big companies are looking at stable coins because they are proving themselves as fairly good pegs to the US dollar. And because they exist on these rails, which is the blockchain, they exist on these payment rails, which are far more efficient and effective than the banking rails. A banking payment behind the scenes can take 3 to 4 to 5 days to settle, whereas on the blockchain, in Ethereum it can take minutes, in Bitcoin it can take 10 minutes. So although people think that's clunky because the user experience in the past has shown that the payment's gone through, behind the scenes that payment's maybe not going through for several days as it works its way through the financial infrastructure. The networks themselves are becoming attractive to established players, and the actual stablecoin assets are getting more and more trusted, although it still is early days.
Just a question on that. Do you think, we've talked about it, and it's been in the news quite a lot, how central banks are creating their own central bank digital currency. Do you think that they will potentially become the new stable coins, given that they are effectively a euro or a US dollar or what it might be? We don't need a stable coin that is linked to a US dollar.
They'll probably create stable coins based on their own currency, first of all. So a US dollar stable coin would be US dollars, and a Chinese yuan would be a Chinese yuan based stable coin. But I don't think they would ever want their stable coins to live on a network they didn't control as well, because the two sources of control in the current financial system is monopoly over creating the currency, so central bank monopoly on currency creation, and also a monopoly over the networks upon which those currencies live. And I can't see a central bank giving that up, because the way they're designing these central bank digital currencies actually go the opposite of true cryptocurrencies. They actually go to the way of giving more control, maybe setting time limits on how long you can buy a stimulus payment, or maybe even saying, well, in China, for example, they might say what you can actually spend the money on based on your social credit score and stuff like that. So the way the central banks are designing these things, they're probably not going to build a stable coin that lives on the Ethereum blockchain like the stable coins we're talking about. They're probably going to create a digitally issued representation of their current currency, and they're probably going to set up a different blockchain which has validators. So the people who control that will be, trusted corporations like trusted banks, or someone who's already got their snout in the trough, will be part of that system. And the cryptocurrency movement is the antithesis of that. It's about freedom and self-sovereignty. The other one's about control. That's probably the best way of answering that.
All right, that makes sense. Let's move on to a couple of the questions that I had. So you had 3 different strategies as a part of that report. First strategy was deposit USDC into a protocol called Compound. Now, one of the you can either do this through the Ember app, as you've detailed, and it's very simple and cost effective to do so. My question is more from those who are maybe interested in doing it on the DIY side. Now, when you said connect your MetaMask browser wallet, what does So you go and buy your USDC through one of the exchanges, like I think you said Binance or Independent Reserve. Now you either do that directly with your fiat, or you go through a crypto like Bitcoin. So you buy Bitcoin first, then buy the stable coins. At that point, what are you doing if you're doing it by yourself? And what does connect your MetaMask browser wallet mean?
Yeah, so the MetaMask browser wallet is basically an Ethereum wallet, and then it can host any Ethereum ERC20 tokens, which most stable coins are ERC20 tokens. So they live on the Ethereum blockchain, essentially. Right. And so what MetaMask is, it's a browser wallet. So you know how you have your internet browser like Chrome or Safari or whatever. It's a wallet that is specially made to work on your internet browser. So it's an Ethereum wallet. You have to download it. So you can download it from the app, the Apple Store, or from Google Play, and then you can link it to your internet browser. Like any crypto wallet, you have to back up the private keys. You have to make sure your passwords are safe, and it's your funds. No one else can touch them. So you have to be careful with all that stuff. But once you'd say bought your USDC from, say, Binance, you would then get your address, your Ethereum address on your MetaMask wallet. You would transfer your USDC to that MetaMask wallet. And then when you're on the Compound page, which is the platform we recommended for the first strategy, you would then have the option to link your MetaMask to that page. So basically, you're just telling your MetaMask wallet that you can interact with this web page. So that's not that hard to understand, I don't think. But until you do it, you might not know what I mean. A few nuances to that. With MetaMask, every time you do a transaction on MetaMask, you have to have some Ethereum in that.
That was my next question. You need to have a little bit of Ethereum in order to effectively pay the fees of doing so, right?
Exactly, yeah. So you have to think of Ethereum. Ethereum is like the fuel in the Ethereum blockchain. Every time you do a transaction, there's something called gas, which is calculated. And that calculation is based on the supply and demand of Ethereum transactions at the time you want to do the transaction. And a little bit will be burned. Now, in normal times, that won't cost that much, maybe a few dollars. But, and this is why I recommended the Ember Fund app for people who aren't, up to speed on this, because at other times when the network's congested, the Ethereum fees for doing a simple transaction can cost like hundreds of dollars. And that's basically because you think about a blockchain is made up of blocks of transactions, and there's only a limited amount of transactions that can fit in a block. So the way that is solved for the miners, the people who are adding these blocks, is, well, they take the highest fees transactions first. So you might be competing against people who are happy to pay a few $100 because they've got, 2 million they're trying to make a trade on or something like that. So you do need some Ethereum in your MetaMask wallet every time you do a transaction with it. In most cases, it won't be that much. It might be $5, might be $10. But if let's say it was a normal case and you'd had your MetaMask wallet, you had your $10,000 worth of USDC on that wallet, and you wanted to deposit that into the Compound platform, you'd go on the Compound website, you would link your MetaMask wallet to the site, and the Compound website tells you to do that. It says link your MetaMask wallet, and then you would just go to the USDC option in the market section, and then it will show you the interest rate that you're getting right now as a depositor. And if you wanted to do that, you follow your nose, click on it, say you want to deposit $10,000 or whatever, and then it would be locked in a smart contract, and you would start accruing those earnings. And it's pretty simple. It's like anything. It sounds complicated, but if you do it once, it's just repeating a number of steps a few times, and it's pretty easy.
And I hope you enjoyed that preview from New Money Investor. To get access to the full video and much more, please click on the link below.